After sideways trading this week, could be the week where we see market volatility resume. The reason for this is simple. On Monday, we have US flash PMI services, the same indicator that helped tank stock markets last month as well. By the end of the week, we're looking forward to US PCE Index, the Fed's favorite inflation gauge. Before we dig in though, let's take a look at the risk disclaimer. Trading is unfortunately high risk and we may lose all of our invested money. And I will also share my point of view on the market and do hope to help you to the best of my abilities. But this does not mean that I'm offering investment advice. Always do your own research. So what happened last week? Well, as I alluded to at the beginning, markets were trading sideways with the exception of gold, which hit new all-time highs 4 days straight. By the end of the week, we saw some welcomed profit taking. The dollar also strengthened, and that happened in particular against the euro, where we started to see the positive effects of the vote in Germany on their big infrastructure deal pretty much being fully priced in. What's also interesting from a stock market and crypto investment point of view, that Trump has shifted from focusing on trade wars to now focusing on real wars. The US has initiated strikes against the Houthi militia in Yemen, as well as Israel has resumed its military operations in Gaza. This, of course, brings about a different type of suffering, but from a market perspective, we have now clearly seen how the focus is being shifted. So people forget about the trade wars and instead focusing on other things. And as well, we saw in the last recent week as well how sensitive Trump is to the stock markets declining. Every time we had trade wars, he has backed off really quickly. And I think it was as recent as last week that they had a show at the White House promoting Tesla cars because of the impact that we're having with Elon and with his policies implemented domestically, but also his involvement in, for example, German politics. So very sensitive to the stock markets, and this shifting away from trade wars to different type of wars is probably going to lead to slightly higher stock market indices. What else? Well, the Fed held rates unchanged, which made a lot of sense. The first rate cut may happen maybe in June. And what did change though is that they have cut the growth forecast. It's now forecasted to be 1.7%, while inflation is anticipated to be 2.7%. Effectively, downward growth, higher inflation, as tariffs are biting the economy, right? That's what's happening right now. And this is obviously not great. If trade wars continue or become more aggressive, expect even higher inflation, as we've been talking about in this presentation, and even lower growth. In the worst case, worldwide recession, even though the way things are moving right now, I think is quite unlikely given the sensitivity that Trump has with the markets. Now, in the case of the Bank of England, the Bank of England held rates unchanged as well, and we had one member voting for a 50 basis point rate cut. Now, that may happen at one point, but for now, wage growth is strong and service inflation is also strong. And as we'll show you in a couple of minutes, we had strong data from the UK this morning. I'm talking about the flash PMIs, and they indicate higher economic growth in the UK, which means that rate cuts will probably even be delayed even further. So with that in mind, I'm actually rather bullish on the British pound, while in the case of the Fed and the dollar, I'm bearish to neutral. In the case of the Bank of Japan, definitely bullish. Why? Because they are behind the curve. They're looking at different type of data. Instead of looking at the headline inflation and core inflation, they seem to be looking at some different measures. They're afraid that inflation will come down rather quickly. Inflation is a bit north of 3% annually, which is too high, given that the interest rate is just at 0.5%. What we also know is that wage growth increased by 5.5% last year, and it's anticipated to increase by roughly the same amount this year. So the unions are demanding higher wages, and they're getting that. But the Bank of Japan is worried of potential impacts of tariffs on the Japanese economy, and they're worried about growth much more, which means that inflation could turn sticky. We'll see. But I think everybody's convinced that at one point, Bank of Japan would be forced to raise interest rates. Now, in the case of the US, retail sales disappointed. So it was only 0.2% versus 0.6% anticipated. This is the actual series that shows the millions of dollars in retail sales. And we can still see that it's pushing to the upside. So we're still in a strong trend, not necessarily too bad as the numbers would suggest. Now, this is a big shocker. This is Canadian inflation. It soared from 1.9% to 2.6%. And this was much higher than the 2.2% anticipated. The reason for this is that we had a sales tax break that ended. What's interesting here, though, is that the bank cut rates as recent as last week amid economic uncertainty. And I think we need to pay very close attention to this. Of course, it's a one-off, right? But will it lead to people now demanding higher salaries because of this? and that could drive inflation. Yeah, that could potentially be the case. So we definitely want to keep an eye on Canadian labor market figures and other inflation figures going forward following this report. It could potentially force the Bank of Canada to pause rate cuts. What are the events we need to keep an eye on this week? Well, let's begin with the data that was out today. So you have Eurozone flash PMIs. This is the composite number, and the prior reading was at 50.2 and the latest reading as at 50.4. So European economic growth is barely holding on. It's sort of neither increasing or decreasing. The last figure could easily be a rounding issue. This is the composite, so that's a combination of services and manufacturing. In the case of the UK, we saw very good figures from 50.5 to 52. Now, this is obviously not very strong, but it's definitely an improvement. And that suggests to me that the Bank of England could potentially be forced to delay rate cuts. In the case of the US, we're waiting for the numbers. They're going to be out later today. This is key because the services figure dropped below 50 last time around, and it was that triggered stock markets to push to the downside. With that in mind, I'm paying very close attention to this, which is going to influence a lot of markets. If you're into stocks, then we have GameStop. They are announcing earnings after market close on March 25th. And we're also looking forward to UK Consumer Price Index. If you're trading the British pound, you can see here how inflation is strong. If inflation continues to be at 3% or maybe slightly above that, expect the Bank of England to delay rate cuts. We also look forward to US durable goods orders and the jobless claims. The jobless claims had a very strong push a couple of weeks ago as the US government started to announce that they were going to cut jobs, and they anticipate to cut even more jobs. So this is something to keep an eye on because this is weekly data and can quickly tell us how the US labor market is doing. For now, the US labor market is doing good. We finished the week with core PCE price index, where the markets anticipate a monthly increase of 0.3%, which is the same pace we saw last month. Now, let's take a look at the markets. So this is Euro versus the USD, and the price was stuck in a range here most of last week and then started to trade to the downside. I personally suspect that this could trade slightly lower and maybe push as low as 107, and in best of worlds, maybe 106 or 105. At these levels is where we find really strong support, and we would anticipate a bounce from here all the way to the upside. But realistically, it will be a bit of a choppy correction down here, and maybe down here we can potentially take action. But let's wait and see. If this goes down slowly, we're probably going to be around the same levels by this time next week. What could aggressively push us to the downside is if the US data later today is really strong, or the inflation readings on Friday. The alternative, which is also very likely, is that we just trade sideways, and then again maybe next week push above this high and then continue to move to the upside. In the case of gold prices, we were stuck in a triangle here, as you might remember, and we said a break to the triangle is going to lift you to the upside. We saw that, we actually reached targets, and looking at this today, it is slightly overbought. It doesn't mean that it can't push to the upside, but people that are waiting for a higher quality setup would probably wait for a slide towards 2,959, and that slide is not allowed to trade much lower than 2,906. Now, this is a 200-day moving average, and it's very clear, of course, that even if we would break these levels, that the multi-month trend is going to remain to the upside. But in the short term, this is what we're watching. In the case of Brent crude oil prices, the price has now formed what I would call a double bottom. So you have these levels here, which is the double bottom. It's very straightforward. When and if we break below that level, then we're going to trade substantially lower, okay? But for now, we are correcting, much like we've seen here, and I suspect maybe we'll dip a little bit lower, but as long as trade above 69.31, I think people are going to be buying dips and then try to push to 72, maybe all the way up to 73.62. But because it's a corrective move, it's not going to be an easy one to trade. So this one is easier to just forget about. But for example, something that would just look like EURUSD is very straightforward. But for example, gold prices that we just looked at is very straightforward trading. We're just waiting for the correct slide. So the Nasdaq 100, last week we said a break to this level could take you down lower, and that did not happen. Instead, we just spent some time here. And if you zoom in here, some sort of from a 4-hour perspective, you can see how we have now reached the upside, and it's probably going to push to 2,400. Around 2,400, realistically, from this level, which is also the 200 moving average, I think people are going to start to sell around this area to then target the downside again. And there's many ways we can trade this. For now, it goes down, so maybe being bullish at 19,600 with stops just below, doing something like this. Okay, but obviously when we come up here, this is going to be tested, and there's a risk that we push to the downside like that. In the case of Bitcoin, it's also interesting, and Bitcoin prices have been guided to the downside by this trend line, and it's been in place here since January 20th, and we're now very close to breaching that level. In fact, or breaching that trend line. In fact, we're breaching this level here. Now, the big problem here is that it's probably not going to be easy, okay? Many times we break one trend line and then we just push a little bit higher, and then we need to draw another one. So it will look like this, up and then maybe down. And then suddenly we're dealing with a trend line that goes like this, and this is fully normal. And then when we break that, we could push upwards. This makes a lot of sense, especially given that the Nasdaq 100 has some very strong resistance up here, and as well the S&P 500 has some very solid resistance here around 5,800. So with this in mind, what's the best play here? Well, what you're trading here on is you're pretty much trading on risk on. So one could trade this via stock indices on a dip because it's a bit too late now, or one could trade maybe a dip here. But realistically, just looking at the charts, I would say buying a dip in the Nasdaq 100 or the S&P 500 with the preference for the Nasdaq 100 is far more interesting from a risk-reward ratio perspective, and it's most likely to hold as well. Because remember, with stock indices, at least these companies are producing products that people are using, and these companies are actually making money. Whereas here in case of Bitcoin, it's still something that people use primarily for speculation, and there's very few of us that use Bitcoin on a day-to-day basis in any type of sort of our real life, which means that this is higher out on the risk spectrum. So people are less keen on holding on to this one. With that said though, I mean, this is the beginning of a reversal, okay? So I would bet, as I said before, maybe up, maybe down, and then next week or so, or maybe 2 weeks from now, when this is no longer a downtrend, when it goes from neutral to bullish, well, that's usually at the best opportunities to trade. And with that, we conclude this week's market update. If you have any questions for us, just leave it in the bottom and we'll come back and try to help you as best as possible. Thank you and goodbye.